Good afternoon, everyone, and welcome to Afternoon Market
Action.
Man, woo! I'm pumped. I'm ready. I'm waiting for it. The Dow just went into the negative. Everything just went down, Patrick. All right, there we go. We were just up 154 points on the Dow. I haven't seen anything. Everything's tanking.
Let's get into it.
Let's get right into it. Let's go straight to the homepage. Everything's starting to go down right as we came on. I didn't see it. Here it comes. 3/4. It's 3/4 of the. There it is. 3/4. So I think that was, and as soon as he came out, we went from 154 up on the Dow to right now down 90. And if it was baked in, why are we moving down? Patrick, what do you think?
I think it's algorithm driven.
Okay.
And once Powell comes on, we'll start to see things maybe bounce back a little bit.
But that's a big jump. That's 100 points. Actually, 200 points, right? Just like that. We were up 154. Now we're down 150, just like that. And I was thinking, how many of you, all algos too fast for anything else, says Jay. I'm with you on that. Don't trust the initial move, says Paul. We'll see. And Patrick is right. I think once Powell comes on and starts talking about why he did what he did, the market will start to react a little differently. Let's go to the market timing graph. There it is. Wow, look at that. Right at the announcement. Right at the announcement. The market fell off the cliff, just straight up. But look at the wick on the bottom right now. You seeing this, Patrick? Look at the wick at the bottom. We're getting a little bit of buying pressure coming in. Whew, my SPX trade just went from loss to profit, says Roger. So we'll see that. And in about 30 minutes or so, we will tune in to what the Fed is saying. He'll have his conference. We'll listen to the Q&A. But in the meantime, I'm glad that we came on right as the announcement was going on. It was interesting. Stock Time said right before, will it be 75 or 1?
Looks like it was 75.
It looked like it was 75. Now all the news is coming across. But CNBC said it right at 2 o'clock. And this is the live response, folks. Look at that. And look at the wick at the bottom. Now getting smaller. A lot more people selling into this news. All right. Low for the day. And still getting more selling into the news. But I'm with Roger or whoever said, wait for the Fed to come out with his announcements. Now we're at session lows. No more wick. Now we're at session lows. And this is what we got going on. Ain't nothing going on but the rent. You got to have a JOB if you want to be with me. And holy smokes. Now, we're not going to be the predictors of doom and gloom. We are just going to talk about what we see. We're going to talk about what the Fed's got to say at 2:30. We'll have them side by side. And I think, Patrick, that as he starts to talk, we'll see a little bit of a reprieve moving up as people start to get an understanding of, I still take my hat off to the Fed for saying that they were going to do whatever they needed to do to go after inflation and that it would cause the economy some pain. Folks, you can't be more upfront and transparent than that. And I think that this move right now is indicative of how true he's going to stay to his word. I said in the Daily Color Guard report last night that if he dropped back to just 50 basis points, market was going to take off like a bird. If he stayed the course, the market could go in either direction because technically, if we look at our indicators for the MTI and buy to sell ratio, we're getting very close to looking for a bottom. But if he had raised the interest rates 1 full basis points, the market was going to fall off a cliff. And it looks like even right now, we're still falling off the cliff until the Fed comes on. What do you got to add to this, Patrick?
I'm wondering if we're going to see the major indices get halted, if we're going to see a halt on the S&P, the NASDAQ, and the Dow.
Well, not yet. Nothing's up over a 1% yet.
I mean, with them
even down
with
1%.
how fast that drop occurred.
That drop went from up right before the announcement. The Dow was up 150 points. Now the Dow is down 250 points. Raising rates won't work. Stop printing money. You know something? I'm with you on that. And Patrick's been saying that for the long time.
Albert.
Patrick's been saying that for the longest time.
Don't
There's
bring
no
common sense into here. There's
no, it does make sense. It does, and don't bring. We ain't got no time for that logic. You ain't got no time. Not big enough move for the circuit breakers yet, says Jay. Yeah, we're not down. Nothing is down in excess of 1% except for the NASDAQ. Close, but no cigar. All right, but the declines are picked up. Everything. Look at the big drop on the VectorVest composite right from that point. It's just, it is what it is. And how many of you are VectorVest subscribers? Type a 1 in the room. How many of you are VectorVest subscribers? Type a 1 in the room. If you need to become a VectorVest subscriber, type a 2 in the room. But I talked about this on the Color Guard report last night. There were 3 scenarios that if he dropped down to 50 basis points, the market was going to take off. If he stayed the course, the market could go in either direction. Right now, it's going down for the time being because it is the initial move. It is the initial move. And the Fed may bring some reprieve when he goes through his statements. A lot of people in here are VectorVest subscribers. Excellent. What is this VectorVest you speak of? Mark, you know what this is. Nobody typed a 2, so that means all of y'all who are not subscribers don't care, and that's fine. That's fine. All right, but a lot, as you can see, for all those non-subscribers, look at the ones in there. Stop, Patrick. For all you non-subscribers, look at the ones in here. There's a lot of people in here who are subscribers. Let's go put this on a 3-month graph real quick. Where are our indicators? What did I talk about last night? I talked about a couple of things. That yesterday we fell through a major level of support. We had a wedge. We broke to the downside of the wedge. And today we're getting more move to the downside from yesterday's close. Now, from that perspective, where's the next level of support on the VectorVest composite? Sitting at the level of about $51.03, and we're at 53. So we still have some more downside. The MTI and buy to sell, look at that. The buy to sell ratio is now below that value of 0.20. At some point in time, the market's going to say enough is enough before we get a bounce. But now we can officially say from the buy to sell ratio that we are in a level of being oversold, and the market could be looking for a bottom.
But let's be clear on this though. You have to close out like that to get the official signals, because that last pullback that we had, the MTI got pretty much right to 0.6 during intraday action, but then came back and ended up at 0.64 or 0.65. So intraday action doesn't count. It has to close out like that to be official.
Does he have access? Oh, you could have moved around in the graph. I wanted to make sure that you had access.
Oh, I don't. I'll request. There you go.
All right. So you can, there you go. And so you can move around as well. I want you to be able to do so. Powell better be more positive than the last time, says Stock Time. We'll see in about 21 minutes what he's going to say. But
let's see if he takes his glasses off this time.
Is he gonna? That means he's gonna be super pensive if he takes his glasses off. That's real. That's the real deal. That's the real deal. If he takes his glasses, you know something? Took my glasses off. This is the real deal, folks. The market does still have some downside, but the market is getting to a point where it's getting oversold. I think that we do get a little bounce. If not later today, then tomorrow. We are at the levels where the market is looking for a bottom. What is the VectorVest promo code that gives you guys a kickback? I don't get that.
Yeah, we don't get kickbacks.
YT? /YT gives credit that it's coming from YouTube if you sign up that way. All right. So what we're going to do, this is what we're going to do. We've got a list of your stocks over the past week, got 11 of them. And we're going to start to take a look at those stocks. We've got 20 minutes before the Fed comes on. Let's see what the Fed says. I'm going to add another graph real quick so that we can keep our eyes on what's going on intraday. There's the bounce. Oh, look at what we got right there on 5-minute bars. Look at that bounce. Look at that little hammer formation. All right, we'll see. This is coming into the Fed in about 20 minutes. Could be a precursor. The 388 intraday on 5-minute bars did go to the fall to the downside. A little bit of a bounce right here on the VectorVest composite. We'll see what's going on. So I want to keep up all of these graphs. Let's go to the viewers real quick. Watch list viewer, customer picks. I'm going to keep this down on the bottom so I can watch the declines to advances, watch the VectorVest composite, watch the news all at the same time while we're doing it. As a matter of fact, let's do this. Let's go. No, never mind. We can watch that is watching the VVC. All right. Whoops. Nope. That is watching the VectorVest composite. So we're watching the VectorVest composite right now, real time, just in a graph by itself, not candlesticks, but in a shaded graph, so we can keep our eyes on what's going on. This week, we had about 11 stocks or so. Patrick, do you want me to start or do you want to start?
I can start.
All right, go ahead. So Patrick's going to take 6 stocks. I'm going to take 5. These are the stocks that we ask you guys on a week-over-week basis. What stocks do you want us to look at? A lot of clean energy in here. Fed is calling for a 4% rate in 2023. You know something? If the market keeps doing what he's doing, if he keeps doing what he's doing, we're going to see. We're going to see if he can get to that point.
Well,
remember, he said he wanted it at 2%.
3.25 was their projection for the end of the year.
And we'll see. This is for 2023.
That would make sense. I mean, that's on par. So getting into it, the stocks that I had this week were DRV. Trying to remember all of them. CCS.
You have Gush.
BNKD, Gush.
AGNC.
AGNC.
1, 2, 3, 4. You got one more. Clearfield, maybe? Yeah, Clearfield.
Yeah, I think Clearfield. All right. So first and foremost, right now, as always check the market timing before ever purchasing a stock. That will tell you whether or not you should be buying them right now or whether you should be just holding off, sitting on your hands. I really just wanted to jump into the graphs, take a look at it from a technical perspective more so than anything else, because a lot of them were ETFs. So let's go ahead. Oh, not graph all.
Go ahead, clear that. Joey was typing. It's all right.
Come on, Joey. All right, I'll just do it this way. Use stock graphs. Get them pulled up.
Now, keep in mind, these are stocks that we're looking at and watching the response from the Fed rate as well, Fed rate increase.
All right, so with DRV, I like this stock right now. Obviously, with rates increasing and expected to continue to increase, DRV really has a lot of upside potential here at this stage, even in this current range. I was reading an article earlier this week talking about the housing market. The housing market technically is already in a recession. Just it's a small part of the economy at this stage, so it's not really impacting the overall economy too much. But yeah, so DRV, obviously nobody's going to be buying a home unless they absolutely have to. So a lot of people already refinanced their homes back after the pandemic. So therefore, the average American, the retail person out there is just sitting in their homes, not looking to repurchase a new home anytime soon. So real estate could easily continue to go down, especially with the increase in rates. So DRV is definitely a great looking play at this stage. One of the things I was looking at is you did have, let me use the freehand line here. You did have a potential head and shoulders where you had the left shoulder here coming down, forming the head here, coming down, and then forming the right shoulder here. Actually, coming down. Oh, let me delete this real quick. Come on. There we go. So move this. This would be the right shoulder here, coming down. So you have this shoulder line basically right at this support resistance zone here. I was keeping an eye on it. It was showing a little weakness, but then with the rise in interest rates, we're breaking above that point, indicating, more continuation in the upward trend. So you had a breakout yesterday, getting followed through here today. I like the look on DRV from a technical standpoint.
Before you go to the next one, 2 things. Go back to that stock. There is one thing that catches my attention is that stochastics shows me that it's getting into the overbought territory, but it did that before. It did that back here, pulled back just a little bit before it came up. I'm thinking that just like what you said, with the rising interest rates, even if it does pull back, it's not going to be for a long time. I think you're right on board.
And that's the thing is, with an overbought, oversold indicator, they can stay in overbought or oversold territory for quite some time. So just because it's there doesn't really mean that, that's going to turn around and go lower instantly. It just means you need to be a little bit more careful and make sure that if you do see any signs of weakness, you lock your profit in sooner rather than later.
And the next thing I had is someone put in, Albert says Volcker went 20% in 1981. How many of you think that right now the Fed needs to be very Volcker-like? He got to the point he really didn't care. He just did what he had to do. How many of you think that the Fed needs to be Volcker-like, type of one in the room? I think the better
question is, how many think that that Powell has the cojones to pull a Volcker?
Well, then we go that way. How many of you think, one, if you think he can be Volcker-like, two, if he just needs to stay the course that he's doing right now? All right, type of one, if you think that if the Fed has the balls to go be Volcker-like. Type of two, if you think he should just stay the course right now. Curious to know. Volcker, man, just he just battened down the hatches, and he did what he had to do. A lot of people saying stay the course. Got a couple of will take our medicine and stop spending federal money, says David. And again, Patrick said this on more than one occasion. We gotta stop spending money. If it's one thing for the Fed to aggressively go after interest rates, but I wanted to address that Volcker question because I keep hearing that being brought up time and time and time again, and I wanted to know what you guys felt about it. All right, Patrick, go to your next doc. Was curious.
Right, so the next one, let me see, CCS, I believe it was. Come on, it's not going.
Yeah, try it again. There you go.
There we go. So building residential on a 6-month basis, you're steadily moving lower. RT is below 1. Once again, rising interest rates is not going to help anything in this space. So right now, it's been bouncing around between a hold and a sell for the last couple of months. I think the recommendation states it pretty clearly that we should not be really considering getting into this. Now, granted, you are at a higher low currently, but it's still pulling back. And until this downtrend dissipates, which you could use a trend line for, until you see this downtrend dissipate, I would be staying away from anything related to housing or residential, building, commercial, any of that. I'd simply be staying away from. I had a few of these today. So banking, now this is an interesting one. This is a contra ETF on banking. Right now, the RT is below 1, but it has been rising. So the short-term downtrend that it has been in has been dissipating. But we do have some consolidation here. You have lower highs being formed. Whoa. Don't know why it did that.
That's me. We're both using the mouse at the same time. That's my fault.
So you have lower highs being formed, but you also have higher lows being formed, by definition showing us a wicked wedge or showing consolidation. Looks like we're getting ready to potentially break out of this downward trend to the upside. As of today, if we do, obviously that's a good sign if you're in BNKD. Banks haven't really been performing as well as everybody expected them to with the rising interest rates. So this could be, a very telling sign of what's going or what to expect going forward. So I like BNKD, but I want to see the RT get back above 1. Gush, oil, the main argument with oil right now has been either a recession, which drives oil prices lower, or not a recession and oil prices start to go higher, or you have the issues going on in Europe. Right now, it looks like the headlines are really focusing on the recession factor more so than the issues going on over in Ukraine and Russia. So, yeah, oil could continue on this downward trend for some time now. If that's what the major analysts and the major moves are going to be pushing towards, I mean, you can't fight the trend. But I think it's a little risky in oil currently because at any point, oil prices could skyrocket based off what's going on with the supply chain in oil and, the fact that the U.S. is already deleting or using our reserves. Russia could jack up the price over there. So while
who's buying their oil besides China?
What?
Who's buying their oil besides China?
Everybody. They're using the same methods that other countries that have been sanctioned are using to still get into the global markets. They're still selling their oil left, right, and center, just at a discount. And, from an economic standpoint, countries aren't stupid. They're going to look to get the cheapest price they possibly can. So, yeah, oil right now, I'd say stay away from, because while, yes, it looks good to play it to the downside, take advantage of oil as the sell-off continues, there's always that risk of what's going on with the Russia-Ukraine conflict. So that could instantly change it in a matter of overnight. So I see too much risk in either direction to really call right now taking or playing oil in any direction, either bullish or bearish.
And that's the answer to your question, Todd, because Todd says, with that said, where would you put an order for, say, XLE? And I think you just answered that question.
So yeah, while the charts and everything and the trend seems to be moving lower or bearish on it, once again, in the matter of an overnight news story or something goes on overnight, that could really change the overall direction of oil. So I think there's really too many unknowns to be too positive on one way or the other.
Okay.
Looking at the next one.
Another mortgage stock.
Another REIT. So I've been talking with our retirement coach, Jim Penna, and we were discussing about REITs and the impact of increased rates. And, while rates don't necessarily impact REITs directly, they do indirectly, in the sense that, REITs are typically looked at as an income generator, similar to like dividend stocks or other ways of, generating income. And with rates continuing to climb, why would you go risk buying a stock just for that income generation when you can go buy, a bond or a T-bill for a few months out at 4%? Why take the additional risk of buying an individual stock when you can get a guaranteed 4% return from a government deal? So I think REITs are probably going to be safe to say that, stay away from for the time being, as long as interest rates are rising. I did a quick look back at REITs as a whole throughout 2007, 2008, looking at when we had rising rates at that point as well. That slammed, REITs in general. So yeah, similar situation to what we're experiencing going into 07, 08. Therefore, going to be staying away from REITs or anything really mortgage related, except for DRV, because that's a contra ETF on it. Going into the next one. Last one, Clearfield Telecom. This stock is oversold. It's had a really steady run, been pulling back. Is it the bottom? Nobody knows quite yet. I would need to see some signs that it's actually starting to reverse course before ever jumping on board and taking advantage of it. It is in a steady decline off of those highs. Where that bottom is, right now it's kind of in limbo, because from a support standpoint, you don't have support until, let's see, a weak level maybe around 80. A stronger support down here all the way around 70 or so. And that's still a pretty significant drop, a 20-some dollar drop on a $95 stock. Nobody wants to sit through that. So right now, it doesn't really have any clear support floors that would indicate that, it could be turning around here in the near future. Support is still a long ways away. So this one I'd be staying away from, especially with the RT steadily dropping, barely staying above 1 right now. My preferred RT is at 1.1 or higher, and we're clearly not even close to that. So yeah, that's going to do it for my stocks. Hopefully, I'm trying to do it quickly so that way we give Glenn a few minutes before Powell comes on. So
all right, we're right at 5 minutes before Powell comes on. So now, interesting, the stocks that I took were clean energy stocks. I think it's going to be a little different, with the exception of Under Armour. My stocks are a little different in that there was a bill that was passed to promote the whole clean energy space. And I think that the clean energy stocks still have a good way to still make money. Tesla being the big boy out of the whole space with the electric vehicle power plug for charging, charge point for charging, Blink for charging. So 3 stocks in here for the charging of the vehicles, and then Under Armour. So in this space, outside of rising interest rates, I think that these are stocks that are outside of the realm of being affected by rising interest rates. The other things that will affect these stocks adversely is the ability to charge the cars that are in big demand. A lot of, if you've watched any of your videos that I've put out, there's a lot of demand for the electric vehicles. If you look at my Twitter account, I tweet about a lot of these things as well. And I still think there's a lot of money to be made in these stocks. And the Fed's coming up in about 3 minutes and 30 seconds. I still think there's a lot of money to be made in these stocks, but you notice all of them, with the exception of ChargePoint, are down today. Now, again, I don't think that these have direct correlation to interest rates. And notice, keeping your eyes on the bottom, look at the little bounce prior to the Fed coming on. Look at the little bounce on the VectorVest composite starting to jump up after the big dip after the 2 o'clock. Just keep your eyes down there as you watch that coming into what the Fed is talking about. Let's just take a look at these stocks on a graph real quick. Put these on a 3-month graph.
And Glenn, while you're pulling those up, question for you. Those are more speculative stocks, newer companies. Are they going to have a hard time financing debt with rising interest rates?
Yeah. And you know something? That's a big part of rising interest rates. There was a video that was just done this week. The 5 facts that you guys got to know as investors, how rising interest rates are going to affect you. How many of you watched that video? Type a 1 in the room. If you haven't watched it yet, type a 2 in the room. And borrowing money, credit cards, your savings accounts, all of these things affect us as investors in the market. So inflation is a bad thing, but the rising interest rates affect us as investors to be able to have the money to put back into our investments. And one of the things with credit cards, one of the things were the banks, as Patrick stated, banks should be a beneficiary of rising interest rates. But the problem is that they're not keeping up with inflation. That's the problem. Credit cards. People are now, putting more money on credit cards because their paychecks are not keeping up with inflation. So how do you get things? You put it on credit cards. If you buy a new house, mortgage rates. If you're buying a new car rates. Education, paying for student debt. Folks, that video, if you haven't watched it, Joey's going to put it up in the chat, and he did. That video was important to answer what Patrick just said, as companies have to borrow money, and it's just part of doing business to borrow money. And if you have to borrow money with rising interest rates, you're going to pay more for that, and it's going to take that money out of your pocket. It's going to affect us in our ability to make money in the market. So yes, Patrick, it is going to affect these companies, especially if they're startup companies, in regards to trying to borrow money. Plug, pulling back 3 days ago. 3 went below the 8. It's got a hard level of a level of support at 25.21. With today's activity, it's moving to the downside. Big wick at the top, also moving down. I can't call this a head and shoulders, but if I could, this would be a shoulder, a head, a shoulder. And is that a neckline? Huh?
It's channeling sideways.
It's more of a consolidation. I'm with you on that. It's in between these 2 levels of support and resistance. But it does have a level of support that it's approaching right now. Looking at Under Armour, man, as much as I love this company and their ability to make money and sell product, the stock is getting to a level of being oversold, right at a level of support. This could be setting up for a rebound. It could be setting up for a rebound. It jumped from a bottom right here at a level of a hammer, jumped up, pulled back down, still continuing the downtrend. Stocks in oversold, but it is stopping right at that level of support of $8.06. The Fed's about to come on. Let me get these last couple of out. Charge point hit a new 3-month high, came back down to 3.8, went negative yesterday, followed through today, but coming off a level of support sitting at 1607. Keep your eyes on that. It's not overbought or oversold yet. And the last one, Blink. A lot of these clean companies, a lot of these charging companies are exhibiting the same deals. A little bit of a shooting star pattern here, right at a level of resistance, pulling back, fell through a level of support sitting at $20.36. Looks like some selling pressure on today's candle. Next level of support sitting at $18.97. So what I'm going to do, Joey's going to bring this over. We're going to keep the market timing graph up here as the Fed is talking. Yeah, huh? No, I want that one. So you're just going to move that over and take up about half the screen. And as the Fed is talking, we're going to keep our eyes on what's going on and see if we can get a little bounce after what we saw from the initial reaction. Here he comes.
I like how they disabled the live stream.
That's right, I get it.
They disabled the chat for this one.
Oh, did they disable the chat?
Look right below the video.
All right, hold on. Let me take this off. Oh, it does. All right. Here he comes.
Good afternoon.
Okay.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal.
And market plunges.
The tools we need
Yeah, I'm watching.
to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate.
His glasses are still on.
Percentage point.
For now.
And we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%.
2% now.
In addition, we are continuing the process of significantly reducing the size of our
Can they hear it?
I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2020.
If you want the volume turned up, everybody hit the thumbs up button.
Following the pandemic recession. Recent indicators point to modest growth of spending and production.
Let's see if that helps.
Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth.
We need more thumbs up if you guys want the volume up.
Business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down
seeing a nice little spike in the market.
Activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low.
Mark.
Job vacancies
I like the way Mark thinks.
highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months.
Energy, when he takes his glasses off, he's really serious.
With demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%.
Look at the bump.
In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation.
Not for long.
The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025.
People are liking what he's saying.
Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 3 to 3.25%.
So now we're up to 3 and 3.25.
We are continuing the process of
Still got a long ways to go.
Of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%.
Compelling.
We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation.
So he's talking about
we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer
So that's going to make markets move.
Of course, these
that right there
do not represent a committee decision or plan.
Saying interest rate or rates are going to decline by 2025.
From now.
Giving a timeline for when everything's going to end.
Steps to moderate demand so that it comes into better alignment with supply.
No, not really.
Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep
you got to remember the markets are forward-looking.
Well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right, so now it's going to be a Q&A section. Quick things that I took away from this. Housing sector being affected. Patrick's questions, Patrick's stocks reflected that. GDP, only 0.2% growth. Jobs, more people than jobs. unemployment rate is going to start rising. Gas prices goes back to Putin's war again. You can't get away from Putin's war, folks. Elevated
things are about to get more serious soon.
Yep, addresses hardships for the people, he's causing the pain, but he's addressing that for some people, depending on where your money is made or how much you make, you're going to feel more of it. The rate of interest right now is at 3 to 3.25. They raised interest rates 3% so far this year, 3%, and data will dictate rate hikes going forward. So there's the bounce after the Fed came on. Here's the big drop after the Fed talked. He came on 5-minute bars to 3 and 8. Now we're going to start to see where the smart money goes. So people are going to start to digest what he said. Again, we're on intraday, 5-minute bars. We'll see. We never overcame this big drop right at 2 o'clock. We started to. We haven't overcome that yet. So, Powell, please don't say pain and suffering. Stock time. Something, again, I take off my hat to him saying that because that was honest. But
I don't think it's really him being honest. I think he knows it's going to be more than that. Kind of like the inflationary statement.
Oh, about the transitory? Yeah. Remember what your Uncle Glenn was saying, that it wasn't transitory? You remember that, right? Look. You remember when I said that inflation was not transitory? I took my glasses off. You remember that? Okay.
Getting serious now.
I mean, it is what it is. So we're going to still keep our eyes on what's going on in the market. There's the actual, and I think that outside of the algos, let's go see how the market digests. Do you guys want to listen to some of this? Type a yes or a no in the room. Do you people, do you chat? Do you want to listen to some of the questions that are coming in? Type a yes or a no in the room.
And chat, help us out. We got 240 people watching right now and only 75 likes. So if you guys are enjoying yourself today and you guys want to help us out, help us with the YouTube algorithms, hit that like button.
Mark says no. Mark, nobody's
I heard it brings
you
you good luck. Rumor is that if you hit that thumbs up button, it brings you good luck in your portfolios.
Decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions
look at that.
To affect,
and you can see by way of the question and answers, look at that big bounce, look at that big pop.
But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy.
See, he's talking about slowing
so that's how
rate
we think
hikes.
About that. Your second question, sorry.
Well, he's almost at his goal, though. So what do you do from there?
I hear you, but what if inflation is not getting better?
I should know better than to answer your second question.
Look at the bump up on above average volume.
Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to
is that Niesman
say with
from CNBC
certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see
now we
in the S&P numbers
the big
is people's
push
views
to the downside.
We're going to hit a new high for the day?
As of this meeting,
we just did.
As to the kind of levels that will be appropriate. Now, those will evolve over time. And I think we'll just have to see how that goes. There is a possibility, certainly, that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today, we've just moved, I think, probably into the very lowest level.
Can somebody just cut the feed for Powell so he just stops talking at this point?
The committee, there's
look at the bump.
Yeah.
Hi, Chair Powell. Rachel Siegel from The Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
The bump.
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are
as of right
high
now
relative to the number of people
yes, especially if you hit stops on your contras.
I'll say that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations are
everything is up now,
fairly
moving
well anchored.
Nicely.
And as I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that
inflation
really
going back to Russia
cycles. And in principle,
not that inflation was happening even prior to the war in Russia.
Some evidence of
you don't want to talk about the money printing. Don't bring that up right now.
To see that. For example, commodity prices look like
can't mess things up right now.
Supply chain
I hear you, Magic Trades. This is a huge rebound.
If sustained, could help ease the pressures on inflation. So let me just say how much these factors will turn out to really matter in this sequence of events.
Look at that, 263 on the Dow.
We have always understood that restoring price stability while achieving a relatively modest decline, a rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive. Or restrictive for longer.
See, that should be a bad
we're committed to getting inflation back down
right there, because now he just
a failure to restore.
And it is.
He took some of that soft landing off the table. And said that we got to be even more restrictive. And look at that. That statement right there.
Yes,
look at that.
Vacancies are still almost 2-to-1 ratio.
He sort of took the soft landing and preparing us, sort of took the soft landing off the table, folks.
Really very good ways to look at how tight the labor market is.
I mean, did anybody ever expect really to hit a soft landing?
He kept that alive until right then. He kept that alive.
Really added value in terms of understanding where the labor market is.
Nick.
I told you we should have cut him off. Somebody should have cut the feed before he got to this point.
The Wall Street Journal.
You wanted 1 minute graphs. There you go, Mark.
In describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point.
So that
and so I was wondering if you could
sort of
discuss
based
how
on
you
the
are
soft
thinking
landing.
about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean
using the word restrictive again,
putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
So since the soft landing statement,
Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
Well, let's see what he says about this.
We make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So when you say pretty quickly, it doesn't take the 1 basis point off the table yet, still.
Now of overdoing it. What's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it...
That guy needs to talk into the mic, man.
...get as much done while the job market is still as strong as it is?
So what we've seen is our expectation has been that we would begin to see inflation come down, largely because of supply-side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply-side healing, but
they haven't seen supply-side healing.
If you look at
how we
respond
to that,
which is
that's another
good
real
measure of where inflation is.
I wonder why.
If you look at it on a 3, 6,
wait,
and
interest rates don't fix that part?
Basis, you'll see that
no way.
Inflation is at 4.8%.
Oh man, if only we knew that earlier.
And 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering
look at another bounce to the upside.
People are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Question: how many of you think he is confident in what he's doing? Type of 1 in the room. How many of you think that he's just jibber jabbering? Type of 2 in the room.
How should we interpret the fact that
I like that
still
statement,
not
Robbie. How many of you think he is confident in what he's doing? Type of 1. If he's just jibber jabbering, type of 2.
As early as 2024, and does that mean there's a level of inflation above the 2% target that the Fed is?
A lot of y'all think he's just jabbering. He's talking around it. Interesting.
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not.
And Patrick has said that on more than one occasion. Patrick has said that on more than one occasion.
Outcome. But you're right; it is a 10th higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase?
Oh, here we go. What you going to say about that?
To do more later on.
Good question,
so
lady.
We, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you have to.
It was
you
continuing to
really,
move lower, just not as low as everybody expected.
I didn't get that.
So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high.
Mark.
It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down.
All right, so why not be more aggressive? Did he answer the question, Patrick?
Not really.
Okay. Does anybody think he answered the question about what she said about just being more aggressive? Type of 1, if you think he answered the question. Type 2, if you think he talked around that answer.
Securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions
he didn't answer that question.
Might affect your plans for how quickly you have the runoff on the MBS side.
Really, Mark? 7?
So what we said, as you know, was
he's not running off the MBS side, though.
That once balance sheet runoff is well underway, I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but that time.
All right, I feel even stronger on my DRV play.
Is not close.
Will conditions in the housing market affect that decision?
I think a number of things might.
Housing market.
Decision, but the main
Bye.
thing is we're not considering that decision.
DRV. I think I'm gonna have to throw on some DRV into my portfolio.
Who's got Jockey Club tomorrow? Steve?
Most likely Steve, because I'm gone for the next few days.
A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down.
FedEx said we are
How
in
do
a
you see
global
that risk? How do you think
recession.
of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
Lower highs being formed?
So we actually, my colleagues and I,
lower highs leads to
one of our
lower lows, maybe.
That's right.
Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives. In our case, the dual mandate, maximum employment price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers.
All right, let's go see what's going on right now.
Ongoing, constant kind of a process.
You agree with that drawing right there, Patrick?
We are very aware of what's going on in other economies around the world and what that means for us.
Not really, but
okay.
The forecast that we put together, that our staff puts together, and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about.
Patrick will be hosting Trending Thursday tomorrow and Midday Market on Monday. I will be back next Tuesday.
They're taking place in major economies that can have.
Please make sure you support Patrick for those two
baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect, so. I don't see it. It's hard to talk about.
No shit, Sherlock is not going to be perfect.
In a world where people have very different levels of interest rates. Remember, there were coordinated cuts and raises and things like that at various times. And
you've said worse than that.
We're in very different situations. But I will tell you, our
all right, just marking the
more or less ongoing.
The tags not safe for work.
It's not coordination, but there's a lot of information sharing.
Just mark one of the tags not safe for work. There we go.
Other important economies that are important to the United States.
Wow. I'm sorry.
Oh gosh, that was hilarious.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the.
This is going to be the last question because we're sitting right at 3 o'clock.
But we've also seen a resilient labor market with durable consumption, strong
labor
corporate
market
profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your
Why is he getting further from the market?
Resilient, and does it mean that we might need a
possible? He leaned back in his seat.
Terminal rate?
You're right, of course. The labor market in particular has been very strong.
Right.
But
too many people have been making too much money. We need to stop that. The middle class has been doing too well. We need to stop the middle class from getting rich.
Showing the effects of our tightening. And, of course, the obvious example is housing, where you see declining activity and of all different kinds and housing price increases moving down. So we're having an effect on on interest-sensitive spending. I think through
Energy said his
exchange
glasses
rates
were
having
on
an
the whole
effect
time.
on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the
I don't
income
think it's
spectrum.
as big as savings as he's thinking.
Savings out there to support.
I do not think he's using that word the way he thinks it's supposed
to. So there's a good reason to think that this will continue to be.
I think a lot of people who are not working were able to not work because they were spending their savings.
Growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to a significant downturn.
But you're raising interest rates because inflation is happening because of a growing economy.
On the thing I started with, which is getting inflation.
No, it's because of the money printer.
No, it's because of the war in Russia.
We can't fail to do that.
Insert the PAL money printer meme.
If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So,
all right, we're doing a little bit of sideways mambo right here.
Overarching focus.
I think we're breaking to the downside. It looks like
in the SEP, in the levels of rates that we'll be moving to, reasonably quickly, assuming things turn out roughly in line with the SEP.
Everything is still
that's
up.
how we think about it.
All right, I'm gonna mute him.
Thank you. And there we go to the break into the downside.
Yeah, there we go.
Lower highs leads to lower lows. Never fails, man.
Yep. All right. So it is what it is.
I told you we should have cut his mic off when I said it, and we'd have been good. Markets would be continuing to rock and roll.
I look at it this way. We still, just what you also said, got to wait to see where the market ends for the day.
Yep.
Right? We don't know. We did go from the big 2 o'clock splashdown. We did recover. Hit session highs. There's the lower highs. The 3 and the 8 on 1 minute bars just broke to the downside. And Mark says it's Trump's fault. Salt Shaker says Russia, Russia, Russia. Marsha, Marsha, Marsha. Russia, Russia, Russia. And you got to throw a football and hit her in the face and break her nose. And that would be this. What did you miss? Mary. All right, let's start from the beginning. Hey, everybody. Welcome to Afternoon Market Action. My name is Glenn.
And my name is Glenn as well.
All right. Well, no, Mary, we're not going to start all over again, but we stayed live with the Fed. How many of you like that, by the way? Type a 1 in the room if you liked us covering that live along with looking at the market timing graph and looking at the questions and all of that. Type a 1 in the room if you liked that. And I think this is not the first time we've done this. Every time there's a major announcement, we try to come on and get you guys involved in it, watch what's going on, how certain questions right here what was that question about? Oh, crap. What was it? Where's my Prevagen, Joey? What was that talking? And it fell. Was it the 1%? I don't remember.
Yeah,
whatever it was.
Why not raise the rates 1%?
Was that there? And what if that was? It fell.
Or
soft landing.
Yeah, soft
landing.
landing.
It was the soft landing. And you notice how the market responded to that. You notice how I love being able to watch these, listen to the questions, listen to his answers, and see how the market responds real time. Wow, got a 10-second lag on the video. We had a lot of people here today. We had a lot of people. Thank you guys for being here. This was a big thing. VV Nation came out today to support the live feed as it happens. I wish that Patrick and I had the opportunity to do a lot more live feeds on a lot of things that happen, but our schedules, just the way that they are, keep us from not being able to do so. But at some point in time, I hope that we get to a point where when anything big news happens that we can get on and talk about it real time, that we can talk about it real time. So it'd be great. For those of you who want to still look at what the Fed is saying, go to YouTube. It's still up there live. We're just cutting it short at 3 o'clock. That's about our time that we have for our session. He's on YouTube. We need another full day long of YouTube live. Well, that might could happen. That might could happen. But, you know, again, outside of what we do here on YouTube, we got other educational stuff that we do. That's the problem. You know, again, hopefully at some point in time, we get freed up to do this all full time. And that will open up a lot of doors for us to be able to cover stuff breaking as it happens live. You know, even if it's a 15-minute or a half an hour live segment with he and I talking about whatever it is, that might be something to keep in mind. All right, real quick before we go, Patrick, you want to tell them? You want to tell them more about this stock market masterclass that's happening?
I mean, you're in it. I feel like that's gonna be your bread and butter.
I hate you. All right, so September 30th, we've got a complete stock market masterclass. It's our next big event. It's a one day from like 9 a.m. to 5 p.m. It's free. Go to www.vectorvest.com/masterclass. Go to that, sign up for it. All right. Once Joey puts that in there, I'm going to show you, there's a lot of stuff we're going to cover. How to build and manage a winning portfolio with confidence. Knowing when to sell to avoid big losses and lock in profits. Pick the right stocks to grow your portfolio. How to profit in a down market. Does that sound familiar? In a down market, achieve consistency with proven rules-based investing. Go to www.vectorvest.com/masterclass. These are going to be your presenters. I am not hosting it this year. Our boss, Ray, is hosting it, but I will be giving a special presentation that will be at 10 o'clock. The VectorVest system of analyzing and ranking stocks. So Dr. DeLito will have a recorded presentation here. Here's the breakdown of the day, folks. We want you to be there. Support, VV Nation, come out and support this next big event, which is the Stock Market Masterclass. Breakthrough techniques that give ordinary investors a massive edge over Wall Street. Go to www.vectorvest.com/masterclass. Folks, go to it. Sign up for it. You don't want to miss it. This could be life-changing for many of you. This really could be life-changing for many of you. It is a real master class on the stock market and how to make the right decisions at the right times. If you're ready to take your investing to the next level, you want to sign up for it, and it's free. Who gives you free stuff that can change your life, folks? All right, so just do that. You got a, I got a Michigan mug. Where's my VectorVest mug? I got a VectorVest mug too. All right, with all that, I'm done. I'm tired. You want to close this out today?
Sure.
All right.
All right. So once again, thank you all for tuning in. Don't forget, tomorrow we have a big day for tomorrow. Well, I have a big day for tomorrow. Glenn will be gone, so I will be hosting our mobile coaching stream at 11 a.m. Eastern, both on Facebook and on YouTube. And then at 2 p.m., I will also be hosting, since cat's out of the bag at this point, I was going to try to keep it a surprise, but...
Oh, darn. Okay, sorry. I didn't know.
I will be hosting Turning Thursday as well tomorrow, so come out and support me. Show some love for the VV Nation. We'll be live. I'll be live both at 11 a.m. and also 2 p.m., both on Facebook and on YouTube. So we'd love to have you guys there. Tomorrow we're going to be talking about charting using the VectorVest Stock Advisory app, and then news-driven articles and what's driving the markets tomorrow at 2 p.m. as well. And then on Monday, I will also be with you guys doing our, what do you call it on Mondays?
Midday market update.
Yeah, that. I'll be there, so you guys should come hang out for that as well. Thank you all for tuning in. I hope you guys have a great rest of your trading day. Take care. Adios and toodles.
See ya.